You see, what has happened in the meantime is the Treasury General Account, that is the Fed, the Treasury, have been issuing bonds to top up their general account, which is taking cash out of the system. So they've withdrawn about 500 billion since July the 16th. That has hit risk assets somewhat. And of all the risk assets, the one that's most susceptible to liquidity is crypto. So crypto got that. The liquidity withdrawal stops about here. We're at the point where we don't need to withdraw any more liquidity, and the Treasury General Account is topped up.
Markets are a reflection of liquidity, and right now, liquidity is about to reclaim center stage. This is the core argument of one of the most influential voices in macro investing and crypto, Raoul, founder of Real Vision and former hedge fund manager. With decades of experience navigating global markets, Powell has been tracking the flow of capital, technology adoption, and the intricate dance of central banks and treasury policies. In his latest analysis, he lays out why cryptocurrencies, despite a choppy start this year, are perfectly positioned for a powerful Phase 2 surge in the so-called banana zone cycle. Over the past months, the Treasury has been issuing bonds to top up its general account, temporarily withdrawing liquidity from the system. This move hit risk assets, crypto especially, harder than others, leading to the sloppy, sideways price action we've seen in Bitcoin and altcoins. Ethereum and Solana flirted with their highs before retracing, leaving investors wondering if the momentum was gone. Powell reassures us, this isn't a sign of weakness, but a necessary pause. Once liquidity stops being withdrawn, and the Treasury account is fully topped up, crypto markets are set to benefit from renewed capital inflows. For investors willing to think long-term and ignore the daily noise, this is a rare and compelling opportunity. So, stay with us as we break down Powell's analysis. We'll explore why the crypto market has lagged, what Phase 2 of the banana zone looks like, and the key signals you need to watch to position yourself ahead of the next leg up. If you're ready to take your investing seriously, hit that like button, subscribe, and turn on notifications, because what we're about to show could redefine how you approach crypto and tech investing.
Here's total global liquidity. We're pretty much at all-time highs, as liquidity is growing at 8% a year. That is the liquidity we think of because we're crypto people or technology investors. We think of this as great. For everybody else, including for your income, this is debasement of currency, and it's totally screwing you over. Your cash savings, all of that, it's all based around this. If you're not beating this 8% annualized growth rate of global liquidity plus 3% inflation, that's 11%, your future self is getting poorer. This is the game we're in. This is why we're taking absurd, ridiculous, irresponsibly long risks in technology and crypto. Okay, why does it matter? It is what Bitcoin is. It is what NASDAQ is. It is what is driving markets. In addition, there are two different scales here. Why? Because Bitcoin is exponential based on Metcalfe's law, which is a network adoption model. So over time, you get the outperformance of the network plus the debasement, which is why it's la land in terms of performance. Bitcoin, Ethereum, all the big tokens. I use Bitcoin because it's easiest, it's got the longest track record to show people within. But Solana, Sui, you choose your thing. It's all based around the same thing. Why it matters, it has a 90% correlation. So 90% of the price action of Bitcoin is explained by this one macro factor, liquidity. Oh, and by the way, 96% of the NASDAQ. So what we have, and I keep trying to explain this to people, I'll explain to them tomorrow in more depth. We have a single macro variable that explains 90% of the price action of every major asset. That makes it the easiest macro risk-taking opportunity of all time because everything else is noise. Everything is just wiggles. You see the wiggles. These are wiggles. It's just noise. Wiggles. It's all noise because this is the trend. You just need to understand liquidity and then you understand the directionality. And if you're caring about the next 3 weeks, the next day, the next month, you are doing this wrong. Global liquidity, what's it doing? Well, global liquidity year on year is not at all-time high. So we're not at the acceleration phase. We've seen global liquidity increasing. It's just ticking down recently. Oh, guess what? The markets have ticked down a bit. Bizarrely, this was the banana zone phase 1 correction, start of phase 2. We think it starts doing more of this now. which is the acceleration phase. It won't do this because obviously we don't have a pandemic. So we're looking for liquidity to rise to something like 10 to 15% a year, stay there for a while, and that will start really driving assets. Okay, so the global M2 chart, here's the 12-week lead. Since July 16th, 2025, we've seen this weird underperformance. And it was like, it's broken. It's broken. See, you are morons for following this. People start forgetting about it. We don't forget. You see, what has happened in the meantime is the Treasury General Account, that is the Fed, the Treasury, have been issuing bonds to top up their general account, which is taking cash out of the system. So they've withdrawn about 500 billion since July the 16th. That has hit risk assets somewhat. And of all the risk assets, the one that's most susceptible to liquidity is crypto. So crypto got that, which has been this choppy, it went up, alts have been outperforming, then they came back down again, and it's been just a bit sloppy. Nothing more than that. There's been nothing really adverse going on, just a bit sloppy. Top of the range for ETH, top of the range for Sol, tried to break out, came back down. Fine. But generally it's because they're sloppy because liquidity has been taken out very fast. The liquidity withdrawal stops about here. We're at the point where we don't need to withdraw any more liquidity and the Treasury General Account is topped up. Okay, so that negative thing has gone probably today, tomorrow, this week, next week, whatever. It's gone. And we start to see that liquidity will play catch up. Does it catch up to this chart? I don't know, but it always has done in the past. And I'll come on to the past in a sec. Okay, then we go to the NASDAQ. It's actually done really well in recent times, following this beautifully, because 97% of NASDAQ's performance is explained by this. But look at this in the past. NASDAQ can do this shit too. This is all based on flows. So NASDAQ is getting consistent flows based on this technology bid that's going on. And it's sucking in capital from foreign investors, etc. And Bitcoin just has been sloppy because it's had less of the capital that was available. So it's the marginal capital. As the marginal capital comes back, Bitcoin outperforms. And I'll show you that. So here is the chart of Bitcoin versus NASDAQ since 2022. So Bitcoin's been outperforming NASDAQ. That's its job. That's what it does. This is why we own it. And it does these kind of nice corrective patterns up, corrective pattern up. And what we've done is we're back near this old 2 standard deviation favorite place of ours, where generally Bitcoin outperforms. Now, I've noticed many of you, and I noticed on X, are all like punting tech stocks and saying, well, crypto, it's boring. It's changed. The market's changed. They're all different now. It's not. Just shit happens. Short periods of time. So that happens. And what will happen is the more of you, I even heard from good hedge fund in crypto, they're like, yeah, we're thinking we're just going to trade more stocks now because, you know, the crypto market's not the same. So what they're suffering from is this. And what will happen is this. It's so fucking obvious. And I use DMARC. This is on Bloomberg. I got told off for Tom DMARC for using a fake version, but I use this anyway. And I've paid for DMARC for 20-something years, 25 years. We've got the 9-13-9 pattern. So that starts to suggest that Bitcoin will outperform technology. Maybe technology corrects a bit. Bitcoin does okay. And then Bitcoin starts outperforming. And I would suggest that alts will outperform. Another interesting chart for you, not related to the liquidity flow, but located to when people start getting fixated on a particular type of market. S&P in the 90s into 2001 versus S&P today has been extraordinarily similar. And that's, you know, this technology narrative, the AI narrative, and how it's taken hold there. So just an interesting chart. Whether it holds forever, I actually doubt it. I think this probably comes up, then comes down. I think this whole cycle lasts a bit longer.
Powell's first major insight is clear. The recent underperformance of crypto wasn't a market failure. It was a temporary liquidity vacuum. From July onward, about $500 billion was withdrawn from the system, leading to the choppy price action and sideways trading we observed. Altcoins briefly outperformed, Bitcoin corrected, and risk assets appeared sloppy. But this was simply the market adjusting to the rapid withdrawal. With the Treasury account now topped up, Powell expects liquidity to flow back into these markets, reigniting growth. Investors should watch for the return of capital inflows as a signal that we are right in the middle of the banana zone phase 2, a phase historically marked by strong upward trends in both Bitcoin and altcoins. Looking further, Pal highlights the bigger picture. Bitcoin's performance is tightly correlated with macro trends like global liquidity and the Nasdaq tech cycle. While some may have expected an immediate breakout, the pace has been tempered by business cycle realities, interest rates, and the need to roll debt. This elongated cycle, now closer to a 5-year horizon rather than the traditional 4, provides more runway for growth. Pal points out that key macro indicators, including the ISM and rates, suggest that we're still in the early stages of this expansion. This creates a rare window for investors to anticipate strong, sustained upside before the next major correction. Next, we'll dive into the signals that indicate Bitcoin is poised to outperform tech stocks once more, and why altcoins could see explosive growth in this cycle.
Why is Bitcoin sort of not wildly off to the races yet? And it's this chart. Bitcoin is basically, this is a detrended Bitcoin, and it's basically the ISM, which is the business cycle. Remember, we've always said it's the business cycle stupid. It is always the business cycle stupid. And all of these people who claim it's the 4-year cycle based around this and that, they don't understand the fundamental of what the business cycle is, why there's a 4-year cycle in everything. And we've explained it, and we'll go through it in great detail tomorrow in our Everything Code presentation. But basically, it's following the ISM. And rates have been following the same pattern. You see, rates should have come lower. They need to come lower because we need to roll the debt. We've talked about this. That's part of the Everything Code, fundamental part. And ISM, because rates are so high, has meant that Main Street has been screwed while Wall Street's made money from debasement. Earnings versus scarce assets. This is the issue that they need to solve, and they need to get rates lower. They get rates lower. Why? Why do we have an elongated business cycle that looks like virtually no other time? It's because, and I only just found this out redoing the work on the Everything Code recently, is that in 2021-22, they actually extended the maturity of the debt from 4 years to 5 years. So that extension of the maturity of debt has pushed out the business cycle a year. The 4-year cycle this time around is a 5-year cycle. We don't know what the next one will be until we see where they all end up getting refinanced. Whether it comes back to 4 because they managed to get some stuff at the long end, or whether they shorten it because everything's in the short end. We don't know yet. But this one is a 5-year cycle. And this is what it looks like. The 5.4-year sine curve, 5.4 years is the exact average weighted maturity of the debt. And it tells us the ISM should peak by 2026. We think liquidity probably peaks before that, as the rate of change of ISM changes and the rate of change of liquidity changes. Our best guess remains well into 2026, probably Q2. We'll have more information on that in due course. Part of that is driven by our financial conditions index. This leads the ISM by 9 months. It says in 9 months' time, we're in September, so this is June, the ISM will be 56.3. That's still not racy. At the tops of the cycle, it actually gets usually a bit higher than that. It usually gets to sort of 58, maybe 60. Regardless of where we get to, in 9 months' time, the ISM will be that. That's June of next year. That tells you the cycle, probabilistically speaking, will end up going up until Q2 next year. So remember that M2 chart. I see a lot of bullshit, again, as ever, on X saying, well, it doesn't work. It's never really worked in the past, blah, 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 blah. So here is what it did with the 12-week lead applied in what we think is the most similar cycle to this one, which is the 16, 17 cycle. And back then, Bitcoin followed it really well. It worked really well. And in fact, Bitcoin peaked after Global M2 peaked. But you can see how well these things work. They're not perfect. Look at all of these divergences where you're losing your shit saying, well, it's doing different things. It's underperformed here. Bitcoin outperforms here. It's underperformed here. Why is it underperforming? In the end, it's all bloody noise. So that's what we're saying. The other one is when we look at a similarity of that pattern, we kind of see that 2026 is more 2017, and that somewhere contextually there's this extra year. And it feels like it's all to play for. And it's very remarkably similar pattern. Again, we're not looking for this to repeat perfectly. We're giving contextualization that if we go longer, the price is going to go higher than people expect. That's a function of that log regression channel I often show you. And I think that is the most likely outcome. And there'll be somebody on X now saying, yeah, you're going to blow everybody up. We're going to try and do our best. That's all we can do. And you guys have to manage your own risk. We're just trying to do the best we can to help you navigate this. And by our probabilistic standards, we think that it goes well into 2026. And you'll probably have, this says like towards the end of this year, you'd have some sort of correction. Well, can you imagine how many people are going to, if we got a little parabol over 200,000, how many people are going to say it's the top? I'd say 70% of FinTwit or crypto Twitter. It'll correct. And then if we're right, then it takes off again. Okay, that's unexpected. And this is what's been in my head for a while, is we're going to trap everybody who has PTSD from the last cycle, and everybody who's the 4-year crypto cycle is sacrosanct. That's my guess. I know there's going to be a ton of people arguing about this. That's my best guess. There's also a bunch of discussion about, hey, isn't this a cycle top? No, morons, no. The banana zone. We are in an elongated cycle. This box will probably be significantly longer than a previous box. We said phase 1 of the banana zone, phase 1 correction. We're still in the early stages of phase 2. Phase 2 is going to take us up here. Maybe that's the 200,000. Maybe it's further. I don't know. We will then have a correction. We saw that in that chart previously. Look, think of this. Oh, look. Could that be phase 1 correction? Ooh, and then we go to phase 2 correction. Oh, and then phase 3 correction to the top. Oh, maybe it is. Maybe it could be. That's what we're talking about. So all the people are like, when banana, it's the same fucking banana. It's going to be a bigger banana.
The takeaway from Pal's analysis is clear. Crypto markets have not failed. They've been navigating a temporary liquidity vacuum. The Treasury's bond issuance and general account top-ups pulled roughly $500 billion out of the system, causing short-term volatility and sideways price action. Bitcoin, Ethereum, and leading altcoins experienced corrections, and altcoins briefly outperformed before retracing. But this is not a sign of weakness. It's a recalibration. Pal emphasizes that once liquidity stops being withdrawn and starts to return, markets will respond aggressively, making the current phase a prime opportunity for patient, informed investors. Pal also highlights the critical role of global liquidity as the ultimate driver behind asset performance. Nearly 90% of Bitcoin's price movements and over 95% of Nasdaq's gains are explained by this single factor. For investors, this means the noise of daily market swings, tweets, short-term trades, and headlines can be largely ignored. What matters is understanding the macro flow of money and how it interacts with technology and crypto adoption. By tracking liquidity and its acceleration, Pal suggests that we are at the start of phase 2 of the banana zone, a stage historically marked by strong, sustained upward trends in both Bitcoin and altcoins. The broader context also reinforces this bullish outlook. The current business cycle is elongated, moving closer to a 5-year horizon instead of the traditional 4-year pattern. Pal explains that this extension is largely due to debt maturities being stretched in 2021 to 2022, which has delayed typical cycle peaks. Interest rates, ISM data, and other macro indicators point to more runway for growth. Unlike short-term traders who focus on daily price action, long-term investors who understand these cycles are positioned to capture significant gains as the market accelerates. In other words, we're still in the early innings of this bull cycle. Historical patterns and Pal's probabilistic analysis further strengthen the case for optimism. By comparing the current market cycle to previous ones, including the 2017 Bitcoin run, he identifies repeating signals. Capital inflows follow liquidity trends, Bitcoin leads technology, and altcoins outperform once Bitcoin stabilizes after corrections. This combination of macro context and network adoption dynamics creates a rare setup where patient investors could see outsized returns over the next 12 to 18 months. Pal stresses that the timing may differ slightly, but the overall pattern of acceleration is consistent with past cycles. Finally, Pal warns that short-term volatility will continue, and not every investor will understand the phase we're in. Many will see corrections and assume the bull cycle is over, but the data suggests otherwise. Phase 2 is about trapping those who panic and rewarding those who follow macro fundamentals. Bitcoin's outperformance relative to tech, the resilience of altcoins, and the eventual return of liquidity all point to a strong, multi-stage upward trajectory. For investors ready to position themselves strategically, now is the time to watch key liquidity indicators, monitor capital flows, and prepare for the acceleration that has historically defined this phase of the cycle. And leave a comment sharing which cryptocurrencies or assets you're keeping an eye on. If you found this analysis valuable, don't forget to like this video, subscribe for more expert macro and crypto insights, stay informed, stay patient, and follow the macro flow, because Phase 2 is here, and it's shaping up to be an extraordinary ride for the crypto market.